I have Larry Goldberg here because it is, what do you call it? Employment Saturday, I guess, because Cathie Wood calls it Employment Friday. We don't report on her Employment Friday until Saturday, so I guess this would be our Employment Saturday show.
Employment Saturday. It's kind of, it's not exactly right? Anyway,
There's something, yeah. We'll have to work
maybe
on
it's part-time Employment Saturday.
Well, I think yesterday's, and we talked about it last night, Larry, but yesterday's employment numbers were certainly a shocker to everybody.
Well, they weren't a shocker to us.
Yes, I know.
I mean, we've been saying on this show I've been saying for some time we're in a recession. You said we're coming into we will have a recession in the third quarter.
Right.
So if you use what will be the official start date of this recession, you're probably right on target. If you use what is the real date for the recession, I believe I've been correct ever since March of this year.
Yeah, we have your theory, of course, the rolling recession, which Cathie agrees 100% with you.
Yeah.
And I don't disagree. By the way, it's obvious that manufacturing and has been a horrible recession. Housing has been a recession, and that's 50% of the economy.
And you know what we'll learn is in this report of Cathie's is that the recession is really only declared a year or so after the recession occurs by the people who are supposed to NBRB, the people who actually are supposed to officially declare the recession. Right. And it takes them about a year after the event started to actually say this was the time of the recession. I really believe they'll start back in March.
Wow. Okay. Interesting. I think it's June, so we're not that far off.
No,
there was kind of an increase of activity that I saw in March and April. Started to slow down in May, and then of course housing completely. Then housing completely went in the toilet in June.
I mean, but the employment reports ever since March have been bogus. Bogus, absolutely bogus. And that's really the determinant of a recession.
Yeah. Well, all right. So that's our kind of beginning opinion here. Now let's see. We'll go into Cathie and we'll give our opinion about what Cathie says, whatever that's worth.
Yeah. And the question is, why not have our people just watch Cathie? And I think the answer is, I think we have a lot to add and also a lot to help people understand what Cathie is saying. So I think there's a lot of value. I mean, certainly a lot of people have told me there's value to us doing this. Yeah.
Yeah, we've gotten extremely good reviews from this. Yes, go ahead. All right.
So I'll start, but of course you'll weigh in as always, and we'll start. This is what, and by the way, for people who are interested, I really recommend listening to Cathie. I mean, she brings such a fresh set of eyes and a very, very experienced set of eyes, but fresh in terms of what people hear normally on the news flash and CNBC and Yahoo Finance. I mean, Cathie really does the subject justice.
Moreover, she has a 5-year outlook, and it's rare. Most people don't have that 5-year outlook.
Yes. Anyway, so this was Cathie last night on In the Know. And so in summary, I think the theme of Cathie's presentation was this quote from Ernest Hemingway, "The sun also rises," which, by the way, happened to be my set piece in my senior year at Scarsdale High School. And I was a big Hemingway fan. He asked in his book, in The Sun Also Rises, which, by the way, and so one of the characters asks a fellow who had been very wealthy and had become bankrupt, was part of his little group of characters, and there were some characters. So the character was asked, how did you go bankrupt? And the answer he gave was 2 ways: gradually and then suddenly.
Gradually and then suddenly.
2 ways.
That's good. That's
Cathie used that theme throughout because, this recession seemed to start gradually. We talked about it just a minute ago, gradually step by, March, May, June. And then today, Friday was kind of suddenly, and that's why the market really reacted the way they did. So markets are now moving rapidly. She says, bond yields are falling, commodity prices are falling, the yield spread is starting to gap out, and fear is seeping into the markets.
The VIX jumped to high 20s.
That's right.
Yeah, it was been around 12 to 16, even sometimes under 11 over the last 6 months. And then, man, and one day it jumped to like 27.
Yeah, so that's the rolling recession to all at once.
Yes.
Capital spending is down. Consumer confidence is relapsing. Housing is relapsing. And as you say, the VIX, fear on the markets, is suddenly, blooming. So yeah, we're in this, it's been gradual, but now it's sudden.
Right. Yeah, it's great. I love it.
And really, Cathie realized, and the market has become aware of, and is suddenly, quite focused on the so-called 𝐶ARM rule. And 𝐶ARM rule is very interesting because this is the first recession that it's received this kind of highlight. And so the 𝐶ARM rule was set, or the 𝐶ARM indicator was created by Claudia 𝐶ARM. She's a chief economist with New Century Advisor. She runs a consulting firm, ran a consulting firm called 𝐒𝐮𝐧𝐝 Consulting. She was with the Fed as an economist. So she created this 𝐶ARM rule. It's a recession indicator. And she says that the 𝐶ARM recession indicator signals the start of a recession when the 3-month moving average of the national unemployment rate, U3, rises by 0.5 percentage points or more relative to the minimum of the 3-month average from the previous 12 months.
Right.
Okay.
Yes.
So it's a little complicated, but let's start by looking at the long view. And the long view shows how many years, going back to 1960, that the 𝐶ARM rule has been consistent. And so you'll see each of these blips is where, the measure by which she sets the rule starts going northbound, or gets to that plus 50%. And you can see some of the rises are very high, which are much, much, much more than 50%. But always starts with that blip at the beginning. And you'll see that blip right here. We'll zoom in just a minute, but you'll see that we are at that blip point, and that's the entry point, she says, for a recession. And of course, the 2008-09 was a mega recession, and it happened very, very, very suddenly.
Right.
That was not a case of, very, very slowly and then suddenly. That was a case of suddenly.
Right, exactly.
But if we look close up into that little area that I've circled, we'll see just how far it's risen. So here it is. And what we're measuring is continued claims, insured unemployment claims. And we'll see that it, blips along. It dropped. I think this was a measurement problem in January.
Mm-hmm.
It dropped a little bit again, but look at the rise now.
Right.
It's risen from its average point of about 1.8, and it's now at 1.88. So that's the short-term view of the continuing claims rising, that 0.5%. So 0.5% in this case is just on 80,000, or just below 80,000, and now we're well above the 80,000. So actually the rise is from actually 1.775 to 1.880, which is, it's about 0.75%. So we're well above the 𝐶ARM rate right now.
Now, she was interviewed over the last 24 hours, and she says that she doesn't believe we're in a recession yet. She believes that the 𝐒𝐮 rule may not be working this time because of the amount of immigration, and that is so huge. And there's so many of these immigrants that are impacting the labor market that the 𝐒𝐮 rule may not be, it may be messed up, at least she's saying. In other words,
Yeah, I don't believe she's right. Who am I to tell
yeah, yeah.
the author of the rule that she's wrong? But I think she is wrong. I
I
think that,
think
yeah.
if I remember the quote fully, I think she believes we are headed towards recession, though. She just doesn't think we're there yet. Of course, everybody, even get 6 top economists in a room and you'll get 7 different opinions is the old rule.
Right. And one of the other aspects of this is just one measure.
Right.
It's a popular measure right now. Everybody's focused on it. But actually, there are quite a few other measures. And by most measures, I think we are in a recession. And certainly, if we're not in a recession, we're in a panic. You only have to look at the market yesterday and see that by and large, we're in a really grave situation.
Right.
Nevertheless, Cathie believes we're in recession. I believe we've been in recession for some time. And, I'm quite comfortable with my view and have been for a while. But anyway, time will tell, right?
Yes. Mm-hmm.
The government body that actually declares a recession will only figure it out in a year's time.
Right.
Looking back, we're trying to figure it out looking at the numbers right now.
Well, one way to look at it is by segment. We know that the housing industry is 20%. We know that the aftermarket for housing, like Home Depot, et cetera, that aftermarket is another 10%. We know that both of those have been in recession for a while. Now you add the manufacturing sector, which has, most people say is 20%. That has been in recession for 2 years, and it doesn't seem to be getting better. It seems to be getting worse in terms of new orders booked. Yeah. So when you got 50% of the economy in recession, that means the other 50% has to somehow make up for it if you're going to stay above the line.
There's another piece of the recession that hasn't been taken into account, and that's auto.
Right, and that seems to have dipped.
Auto, the market has taken a hell of a shellacking just in the last month or so. And so I think that's a huge percentage of the economy as well. So, take all into account and you have a really serious situation.
Okay.
So and the other thing is, I think that the 𝐒𝐮 rule does apply because I think that the number of unemployed, I doubt whether the newly arrived, non-documented immigrants are having an impact as material an impact as she thinks. I think they're having a negative impact because not only are they not working, but they are actually getting some benefits, and there's a huge cost associated with them. Anyway, that's a separate matter. Then Cathie talks to us about the yen trade and how it's being affected. This is a trade. It's called a carry trade, if you wish. And what is it all about? It is about this, that the Japanese yen has for the last umpteen years, I think since 1988, been depressed in value, and their Reserve Bank have been lending money, have been giving money away at extraordinarily low rates, which means that you can borrow yen, invest them in US stocks, and or bonds,
Mhm.
pay almost nothing to the Japanese, and earn a whole lot from the Americans, feeling confident that the Japanese Reserve Bank will maintain the value of the yen, or that the yen will retain its value, as it has done through these many years.
Right.
And you make a lot of money. And that kind of trade sucks in a larger and larger and larger universe of traders over time.
Right.
As people build confidence and, see other people making a huge amount of money, fear of losing out is one of the most powerful motivators on the market. And so we have this gigantic amount of money in the Japanese yen trade. Unfortunately, the rule that the yen always, goes up is suddenly broken, and the Japanese Reserve Bank is allowing the yen to subside to probably more realistic prices, and suddenly people are going to have to get out of that trade. So they're going to have to liquidate their investments in US stocks and bonds and pay back or scramble back to a zero position. So that trade is now reversing, and it's having a huge impact on the market. And that's the thought. I mean, there's no proof of that yet. We'll only be able to see that in due course, but it could be pretty serious.
Cathie didn't bring it up, but there's also the Bloomberg. I'm not the Bloomberg. Never mind. Let's just move on. I can't remember the story.
All right. So if we look at the 10-year treasury yield, we've had since 1980 a fairly consistent drop, and Cathie's actually drawn a line into this graph to help us understand the trend, although the trend is pretty visible.
Yeah, right.
Since 1980, the treasury yield has dropped to, the bottom that was reached in 2020. Part of it is, the confidence that people have in the dollar compared to all the rest of the world. And part of it has to do with, just plain printing of money, and so we've had this belief over time that, the treasury yield is always going to be a very low number. Well, it's no longer that low. It's now at about 4.5. But the yield rose very dramatically. So the question is, are we going to now revert back to this trend?
Right.
And so that's the kind of overriding question, and that really will determine what happens in the next couple of weeks.
Yeah, and we saw this already drop from that 4.5 that you just mentioned, which had kind of been the number for quite a few weeks, and all of a sudden down 50 basis points in a single week, ending the week at around 3.8. So that is a very substantial drop in a bond market which is not normally volatile.
Yeah, and so this trade, buying long-term treasuries, and I will admit to having participated, because treasuries are a very large proportion, if not actually the largest by far proportion of my portfolio.
Okay.
And so we're seeing those traders who entered that trade beginning to really see the reward of their endeavors.
Mm-hmm.
But I don't think we're even close to done. I think if you look at this line, I think we're going to get down, firstly, I think the long-term rate is going to fall below the short-term rate. I think we're at that point.
Right, right.
And we've always said on this program that the recession always reflects the point, not where there's a differential, where the long-term rate is exceeded by the short-term rate, but when the long-term rate actually gets back to trend below the short-term rate. And then at that point, that's generally the signal that the recession has arrived.
And on Friday, and I think she mentions this, maybe you'll have a chart on it, it got back down to 10 basis points.
Yeah, I didn't have that in the chart.
Okay.
She mentioned it. Her chart was, a good month old almost.
Oh, okay.
And so that's why it's showing 4.5. We were down to 3 point something, I didn't check it actually on Friday.
Yeah, we cover this every single morning, every single night on the show. Yeah. And it was running around 33% for 33 basis points for a very long time. Then it dropped all the way down to like 16 over a few days, went back up into the 20s, but then Friday it dropped from like 23 to 10 in a single day. It was very big.
Yeah, you kind of see it actually in this chart. You can see those movements. You just look at this little section here. Yeah. You can see how it rose to 5, dropped, and that was the point at which it looked like there was going to be a reversion to norm, and then it rose back up again. But now, since this chart, it's dropped, and it's down to, down here somewhere, actually. So we're definitely getting there, and short-term rates, of course, are going to climb.
Right.
Right. So then we can talk about the metals to gold ratio that Cathie, is very keen on. She loves this particular chart. And the question is, will we revert to norm? And so her point is, it's not the metals that are gonna go up. In fact, the indications are that they're going to continue going down, or they are down. It's probably the 10-year treasury that's going to fall in line and return to the the last 30-year norm. So that's really what is in process of happening right now.
Right.
So we can expect a very substantial 10-year treasury yield drop.
Yeah, I think the other day I mentioned on my show that I think we'll be looking at the next level is 3.25, which seems to be a stopping point. So that might be where we might see.
I think we'll penetrate that point.
And I think we will penetrate that. I think I'm just saying, I think we'll stop there for a bit. We'll take a rest around there. And then, yes, I think we'll go down into the 2 handle.
Yeah, and there's every possibility we won't stop there, even to rest. I mean, these movements can be very, very, drastic, and so what's going to happen is the pattern's going to change.
Mm-hmm.
We're used to a pattern. We've talked ourselves into that pattern. But all these patterns are going to change because we're in the suddenly phase, the slowly, and then suddenly we're in the sudden phase, I think.
Mm-hmm.
Then the Bloomberg Commodity Index, people have been talking about inflation, but if you look at the commodity index, the Bloomberg Commodity Index is a mix of commodities. It includes oil prices, which is such an important part of commodities. Mm-hmm. It includes copper, it includes all of the major commodities. And it shows that since 1975, really, commodities have really hardly moved in terms of pricing.
Right.
And so this would argue that we've been in a long-term period where there's no inflation. So, I think that, that really is where we're on this situation where we're going to see deflation rather than inflation.
Yeah, I mean, of course, commodities are only one part of the inflation picture, but the commodities are a big part of the inflation picture. And personally, I think that commodities will probably drop a little more, but I don't think they're going to drop a lot because they already have. And we may be getting to some levels where people will just take production. They will just stop mining. They'll pull up. They won't pump gas. Won't pump oil. They won't pump gas. We see this all the time, and they pull back in terms of production.
I want you to pay attention
To that number, huh? Yeah,
to
right.
how low commodities go
Right.
in recessions.
Yeah.
So, having grown up in South Africa, grown up in a business sense in South Africa, I know a lot about commodities.
Yeah.
I have many, many stripes on my back from the lashings that I receive from commodities. And you would be shocked to see how low commodities can go. Shocked.
Okay. All right. Well, I'll
And
bow
so
down.
and by the way, that's the suddenly part of it.
Yeah.
So it's quite possible that commodities could, mosey along or go down a little bit, but this is how far they can go. Just look at this number, look at this number, and look at this number. I think it really turns on how vicious this recession is. And we're how many months? 6 months away from 5 months away from an election.
Yeah, four now. Yeah.
4 months. 4 months away.
100 days.
Well, maybe,
100 days. Yeah.
Yeah, maybe it's short enough that 100 days, even less than 4 months. Maybe it's short enough that maybe not extreme action is taken. But it could be that in 3 months' time we're in the midst of a terrible time, or an apparently terrible time.
Well, what happens with commodities? Again, you've had your experience on one side of it. My experience was buying and selling large amounts of plastic, or buying large amounts of plastics. And what happens is all of a sudden you've got companies all have their orders in, and they've scheduled their orders out for the next months. And then all of a sudden you pick up the phone and you say to your commodity broker, you say, look, I cannot take that next train load. I can't
Stop.
you can't send it. Well, then I've gotten that phone call from that broker, and 5 minutes later saying, I've got a train sitting on the track loaded with plastic that you want, and I can give it to you for this price right now. And there's, that's when you see the breakdown start to really hit.
Yeah, and what happens is, play that back all the way to the mine.
Right.
That's where the rubber hits the road, or
Yes,
or hits the dumpster or whatever. I mean, at that point, the mine shuts down.
right.
And that's the beginning of the process of commodities going back up to the peaks again.
Yeah, exactly. Yeah.
So the 10-year yield, treasury yield minus 2 years. So we can see that the yield curve is inverted. It's only 10 basis points because short rates are rallying together, and you can see that. Let's see if we can't make this. I guess we can't. So this is the 10-year treasury yield minus the 2-year, and we're going back maybe a month or so.
Oh, okay. Yeah.
Right. So this 10-year yield curve, we're a little bit behind it already. So there's a deflationary undertow here.
Yes.
And we're still negative for the longest period of negative inversion we've ever had. But, clearly from the most recent figures, we were about to break through this line.
Right. Yeah, almost certainly this next week.
Yeah. So we'll see. I mean, the question is, does the Fed come back next week or in the next couple of weeks and say, never mind, we are going to drop by a quarter of a point, or I would prefer a half point. Right. That would be the right thing to do.
Yep, we talked about this last night, and I've been watching a lot of the debate online about that, and there's certainly plenty of it. I'm with you. I would like them to do it. I don't know if they're going to do it or not.
Yeah. Yeah. So now we'll go on to payroll. This slide just says it all, doesn't
Boy,
it?
doesn't it?
And you know something? This slide is not right. It doesn't fully reflect the extent of the problem.
This is one of my favorites, Larry, and I think the Fed chairman has mentioned that he likes this one too, because this is longer term. This is continuing claims. It's somebody who's been on, out of work now for enough time that they're starting to collect the insurance. And I believe they have to have 2 weeks of insurance. So you get a week, I think it's a week before you can collect. Maybe it's 2, I can't remember now. It's been too many years since I cared. It's 1 or 2 weeks before you can start to collect. And then this is 2 weeks after they begin to collect. So this is somebody that's been out for a while.
Yeah, but that's the problem. It doesn't reflect what's happening today.
Yeah.
And that's why I say it doesn't really fully reflect the extent of the damage. So if people were laid off in the last month, they're not in this list. And I think that's where that's the problem, is that we're seeing a gathering of speed of this decline. So this particular representation, while it's highly reliable from a statistical point of view, because it's just how many people are out there claiming unemployment or receiving unemployment, I should say, and continuing to claim unemployment, doesn't reflect the current situation. And the current situation could be significantly worse.
Rasmussen has a poll. I didn't know about this till this morning. I didn't know they did this. They talk to about 8,500 households every month. And then at the end of the month, they give their final report.
Ah, that's interesting.
And they're at 8.4% of households saying that 8.4 of the people, percent of the people they talk to say they are currently unemployed.
See, that's a number I can actually count on.
Yeah.
How does that, do you have a series of that? Do you have a number over time?
I just found it this morning, and it was up. It was definitely up, but I didn't look to see a historical pattern on that.
I think we should include that in future.
Yeah.
And maybe bring that to Cathie's attention, because it would be helpful, I think, in terms of, see, most of these employment numbers some of these employment numbers are bogus.
Right.
They're statistically unsound. Some of these employment numbers that aren't bogus are very backward looking.
Yes.
This is a particular example of it. And this is why I said it's not, I mean, I know you like it because it is accurate. I don't like it because it's old. And in the sudden moment, when you're in the sudden moment, it can't actually give you the number.
Yeah.
You see what I'm saying?
I do. No, I agree with you. Yes.
Now Cathie turns her attention to what's going to happen with stocks. Okay, we're going into this recession. How serious is the recession going to be? Who's going to get hurt? And what does it mean for your investments? These are all my thoughts, not necessarily hers, but I'm interpreting how she puts it.
Right.
And one of the points she makes is that there's probably going to be a reversion to the norm, because if you look at this slide, it's about the market cap of the largest stocks relative to the 75th percentile stock. And this just shows you where the Magnificent Six or the Magnificent Seven or what were they before that? They were what was the?
Yeah, I can't. Yeah.
Yeah.
Anyway.
the Mag 7 or the Mag 6, this was them, their market cap relative to the 75th percentile stock. So this is showing you how much concentration of the market is in these 6 stocks versus, the 75th percentile of the average stock. And it reached, this 750x, which even exceeded 1932.
Yeah.
In 1932, so many of the companies went bankrupt. People got out of stocks other than the General Electrics and the AT&Ts, or the top, I think it was 50, but maybe even less stocks at the time. And so the concentration got to a point that was very high. Then, when the recession ended, it reverted back to the norm. Actually, there was a double recession because there was the 32 and then 37, but it reverted. And that's been true of every major peak in the past. So Cathie's argument, it's going to revert, and it's going to revert to those companies that she identifies as, the companies that are going to be the most innovative companies in their space. And innovation is going to save us from this recession because it's going to bring a burst of productivity, a huge burst of productivity, such as we haven't seen, in our lifetimes.
Right.
That's the thesis. And I don't necessarily disagree with the thesis. There's a lot of theory out there about this concentration issue because it's become a real issue, but there's no doubt that we have to revert somewhat to the norm.
Yeah.
And I wouldn't be surprised.
Well, there's a bunch of things going on, Larry. So let's talk about these, because I asked on X, I asked people to put their questions out for you and I this morning. What did they want to hear about? And the number one thing they want to hear about is this subject. So one of the things that I think people need to think about in terms of this reversion would be that the reduction in interest rates that the Fed is now saying is, where everybody agrees the interest rates are coming down, as a matter of which day. This interest rate reduction is going to help small business the most.
Yes.
It's going to put contractors back to work building houses and apartments. This is going to put this is going to allow small businesses to improve their bottom line. And it's also going to help the valuations of small businesses who are aggressive because of the percentage that you'll use to get back to present value when you're valuing the company 5 or 4 or 3.
The discount rate.
The discount rate. So all of that is going to really, really help small companies, and that all of those things should boost the Russell, should boost the S&P 300, should boost et cetera, even in including the absolute small businesses that won't be reflected, in the stock market, but should help Main Street as well. So this is where you get your boost, but it takes 5 months, and the stock market does look 6 months out. So we might start to see, some of this trade get stronger and stronger over the next month or so. But to actually see the bottom line affected, you're talking about 5 months.
Yeah, and that's not a bad analysis, Randy, because, I go back to 2008, which is kind of the mega recession since the 1970s. I mean, I was in the 1970s recession, as I guess you were too.
Yes.
And that was brutal.
Brutal.
Yeah, because it never ended. It just seemed to go from one recession to another. But classically, if you look at the 2008 recession, which was the worst recession in modern times, that is to say, since the 80s, that recession, the market collapsed on September the 15th.
Yeah.
And the market recovered on March the 8th.
Yeah. Yeah.
Which I remember well.
Yeah.
Because my birthday is on March the 8th. And so you take September to March. How many months is that? September,
months.
October,
6
November,
months.
December,
6
January.
months. 6 months. Yep.
6 months. So that, that's really the kind of standard timing for a recession.
Yep.
I've said on this program, and I've always said, the good news about recessions is they're short.
Right.
The bad news about recessions is that you can never predict who they're going to hurt.
Right.
To quote another literary source, every recession is different, Right. So all expansions are the same, like all happy families are the same, but like all unhappy families, they're unhappy in different ways. And so this recession is going to be a recession in different ways.
There seems what I think we can start to get our our arms around, though, Larry, is it's going to be from a lack of spending. I think it's not going to be from some government edict like the 1990 George Bush recession. It's not going to be because of a pandemic or some crisis in the financial community. It's just a flat out, the consumer's done, small business is not investing, the government has spent all they can spend, and they're not going to be able to save us. And so you've got no spending, and the spending thing theoretically should work its way out in that 6 months that you're talking about, theoretically.
Well, look, there's an enormous amount of cash on the sidelines.
That's true, yes.
Which is diametrically opposed to this concept of the Japanese carry trade dying.
Right.
Because, on the one hand, you're going to have people who are very, very illiquid. On the other hand, you've got a lot of this cash on the sidelines. I'm not sure how that balances out. I'm not sure what the dynamics of those are. It's very complicated.
It's hard to know.
Yeah, that's the one thing. The other is, a lot has been said about the so-called cash on the sidelines not really being liquid.
Yeah.
And so there's that issue. So I think there's a lot to be considered here. The question is, will the small businesses make it through the 6 months? Will they survive? Will there be a large number of bankruptcies? How high, if high, will the unemployment get?
Right.
Because the unemployment rate right now that is being, advertised by the government is not true. I mean, it's completely behind, and it's completely wrong.
So, Larry, the other question that people were asking is whether what we think is going to happen to the stock market. I mean, Cathie doesn't talk about that. You mentioned last night that you think that we both I think we were in 100% agreement that we do believe that we're probably looking at a full 20% pullback on the S&P and the Dow, and a 30% pullback on the NASDAQ. Is that's still where you are? Mm-hmm.
Yeah, I think the Magnificent Six, or the whatever they are today, what are they called? I think they're going to take a hell of a beating.
Yeah.
I think the earnings multiples on them are way, way too high. And by the way, Tesla will probably take a beating as well, unless something dramatic happens on the FSD front, which, by the way, could happen.
Could happen.
I mean, it looks like it's happening in real time.
Yes, it does.
But I mean, that besides, I think that from a financial point of view, I think these gigantic multiples are going to be shaved. A gigantic multiple just can't work that well for such a huge company.
Yeah.
But they're the ones sitting with the big cash balances.
And not only that, they may be impacted also, though, by the reduction in interest rates, making it more easier to sell cars, as well as, again, reducing that discount rate for the present value.
Yeah. And that's going to take 6 months to work through.
Right.
Of course. So, it's a very complicated set of gears that are intermeshed and turning, and I don't know that anybody can figure it out. Cathie feels very strongly that this is the time that her bets on these innovative small companies are going to blossom.
Yes.
Who am I to disagree with her? I mean, she's, she's got an uncanny sense of that. Although she's had, because of what we've been through since COVID, the ups and the downs, her strategy hasn't looked good. But it could be that we'll return to the good times. So that about does it.
Okay, well, let me just comment then on productivity, because this was I was trying to find a chart on productivity. I could not find a current one. And so what we saw was a nice increase in productivity last week, back to 2.3%. That's not a hugely great number, but it's not bad.
But you know why we got it.
Why did we get it?
Yeah, you know why we got it.
I assume because people were laying people off.
I think so.
My theory.
I think that's true.
Okay, so this is what I've been saying for some time, and Cathie, I think she agrees with me 100% on this, because she mentioned that corporations are no longer holding on to those excess employees that they've been holding on to because they were afraid to let them go. And I've been saying for, I don't know, a year, that when that happened, we should see a pretty good increase in productivity. And I think that's exactly what we're getting right now. I think a lot of the layoffs right now are excess employees that are being let go. The real question becomes how many real, I'm going to call them real layoffs, happen over the next couple of months, meaning companies that are in trouble. My experience, and for those of you who are new to the channel, I worked with over 400 small businesses during the last 16 years as a marketing consultant for these companies, many times as a business consultant as well. And my experience with small companies, and I've asked some people in larger companies, and they say it's the same thing is true, is that companies are reluctant to let people go. People actually like their employees. I know that sounds crazy, but most owners like their employees, appreciate them, are friends with many of them. And they're reluctant to let them go. And I saw company after company after company, in my experience, wait until it was too late, till they actually would lose their company or come close to losing their company because they held on to the employees too long.
Absolutely right.
This is what you're going to want to watch over these next 2 or 3 months. If people wait too long, and then all of a sudden you have a flood of people being let go and the bankruptcy start, that could cause us to go into a different kind of recession that could take another 6 months to get through. It'll be a better recession because it'll clean out more bad stuff, but it won't be as fun. And when I say fun,
Look, there are no good recessions, and therefore there are no better recessions, but the outcomes could be better.
Yes, the outcomes. Yes, exactly. All right, Larry. Well, we did it in less than an hour. I don't know what happened there.
Well, I'll tell you what happened. Cathie cut down the number of slides she used.
Yeah, she did.
She cut them down to the bare essentials.
We've been having to add our own slides in because
we did add a few slides.
Yes, because we liked her slides. Cathie, we want the slides back.
But look, I tell you what, everybody should actually go and watch her piece, because she has an inimitable style, and I think that there's a lot more value to be gained than what we've told you. I think if you've enjoyed what we've done, then you should go and watch Cathie.
Sure. Although right now there's so much to watch, Larry, it's really impossible, I think, to watch all of it. I'm only 2.5 hours into the Lex Fridman Elon Musk video.
I haven't started it yet.
2.5 hours into the 8-hour. Wow. It's amazing. Oh my goodness. So all right, Larry, thanks as always for helping us out. And Larry worked really hard on this one. So let him know in the comments below how much you appreciate the hard work he put into this one.
Thank you, Andy.
All right, thank you. And to all of you out there, it's been great talking to you.